Joining me on the line to discuss the state of the Israeli economy and the future outlook is Tatha Ghose, Senior EM Economist at Commerzbank in London. Now, the Bank of Israel kept interest rates on hold at 0.1% yesterday, but the decline in energy prices and the appreciation of the shekel may hinder the bank's target for inflation this year. What is your growth outlook for Israel this year and next?
We expect 3 to 3.5% growth for both years. In terms of specifically the profile difference between this year and next year. This year we expect growth to be more consumption-driven as it recovers from what was going on during the Operation Protective Edge last year, which had dampened sentiment significantly. And once global economic recovery has gone on for a few quarters, and next year we expect the mix to change more in terms of fixed investment growth driving the process. So on officially, our forecast is 3% this year and 3.6% next year.
The shekel appreciated by 7.1% for the year to date, and this coupled with the slowdown in China, how is the trade sector faring?
Yes, the trade sector has been depressed since last year. We don't see this so much a function of China, which has, only begun to slow down now. But U.S. imports, especially the high-tech sector, had been very depressed through last year. If you go back a year, the U.S. IT import growth, for example, was running at flat, so 0% year on year. And that has improved to about 4% this year. This is pulling up Israeli exports. The export growth rate, smoothed 3-month moving average, is still in the negative, but it's much less negative than at the beginning of the year when it was running at about minus 12%. Now it's improved to minus 2, minus 3%. So the trade sector is depressed. We see this also as a function of lack of business interest while the geopolitics was very shaky surrounding the military operations last year. And since then, things have normalized and the production capacity of the manufacturing sector is returning to normal. And on that basis, there is a gradual recovery in the exports.
Now, in your opinion, is there any need for the central bank to intervene in the currency markets to weaken the shekel? And if so, what measures could they take?
Right. No, we do not see any need. And our experience is that it has never worked. They regularly intervene, but that at best creates some phases of sideways movement on dollar shekel. I've never seen it reverse the underlying trend. They could use negative interest rates, which has been widely debated, and the regulators have even asked banks to look into what they would need to do if they had negative rates. So it has been actively discussed, and the other option would be an FX cap. But both are problematic because Israel would typically track the U.S. Fed's stance on monetary policy, and once a cycle there has turned towards the hawkish and they will be raising rates, to see Israel go into uncharted territory with negative interest rates and create a much higher or wider rate differential between itself and the U.S. is unlikely. Similarly, the FX cap idea, since the Swiss National Bank's abandonment of their floor, the credibility of these caps has been questionable. The Czech Republic is facing the same thing at the moment, where speculators speculate against the central bank's ability to hold the floor, and this complicates monetary policy. So we don't see them doing unconventional policy at this stage. Rather, we don't actually see them intervening in unlimited quantities to weaken the shekel either. So we think that they will accept, the Bank of Israel will accept a gradually strengthening shekel, which will be in line with a more a stronger and recovered economy next year. So we are forecasting about 3.6 on the dollar shekel.
Well, thank you very much for your comments, Tatha. Well, that is all from me. So for now, it's goodbye.